The S&P 500 dropped 11% in 2 days, and it got a lot of people freaked out. And especially coming off 2 back-to-back years of over 20% plus gains in the S&P 500. So people are not used to their portfolio going down so suddenly. It seems like the last 2 years, all the market has done is gone up. So just hit new high after new high. So when we had those 2 days, one day I think it dropped about 5%, and then the day after it dropped about 6%. So after those 2 sharp drops, it got a lot of people really thinking about the level of risk that they're comfortable with taking. I was talking to someone the other day and they said to me, boy, I wish there was a way to insure my portfolio. And I started talking to them about different ways to manage risk with your portfolio in retirement. And the most common way is to put a certain percentage. If you want to take less risk, you put more in bonds and less in stocks. And that's probably the most common way to do it. You also make sure that your investments are not correlated with one another, so they kind of go up and down at different times. So it kind of smooths out the volatility over time. But another way to manage risk would be to purchase what's called a put, or what some people call it is a protective put. And what that is it's a type of option that would go up in value when the stock market goes down. Now, from my personal experience with trading puts, if you were to buy a put that ensured that your portfolio would not lose anything in value, that's pretty pricey. That would be expensive. But a more viable strategy, in my opinion, would be to buy what's called a deep out of the money put, which means the more risk you're willing to accept, the cheaper the cost of that protection is. So let's say that you were willing to lose 15%. Well, that put wouldn't start going up in value until the market dropped over 15%. So you would be willing to accept a 15% loss. It doesn't have to be 15%. Maybe you'd be willing to accept a 10% loss. Maybe you'd be willing to accept a 20% loss. But the more of a loss you'd be willing to accept, the cheaper the cost of that protection. So one of the big advantages to buying a deep out of the money put that wasn't super expensive would be that if the market did crash, you'd be less likely to sell your stocks, so it would keep you in the market. The greatest mistake in investing, in my opinion, is when the market goes down, people panic and sell at the bottom, and then it goes back up. When it rebounds, people then start hearing positive headlines, and then they get back into the market. So they sell at the bottom and then buy at the top, and that cycle just keeps repeating itself. And that's one of the reasons why an average investor has such a low return each year, is just trying to get in and out of the market and selling when they're scared. So if you did have the put and you knew you could only lose a certain amount if the market crashed, you'd be very unlikely to sell your stocks and get out of the market at the bottom. So I do like that aspect of it. One interesting way to look at this is most people have homeowners insurance. Now, if you buy a put, a protective put, and the market it goes up while you own the put, you would lose the premium the price of the put. You'd lose 100% of the value of the put that you purchased. So someone said, well, boy, you could lose 100% of its value. That's very risky. Well, if you view it as like you do with your homeowners insurance, I mean, at the end of the year when I have to pay for my homeowners insurance again, I don't think to myself, oh, I'm upset because my house didn't burn down. I think, oh, I'm glad my house didn't burn down. I'm going to pay another premium for this upcoming year to protect myself against a catastrophic loss. So if you viewed it that way, it really is a lot like insurance. Now, in this case, it's not like you're buying insurance from an insurance company to protect your portfolio. It's between you and another investor, but it is a contract and it is legitimate, and it would protect your portfolio or hedge your portfolio from a significant loss. Now, again, you could tailor, or working with your financial planner, you could determine how much risk you're willing to accept or how much you could afford to lose, and that would determine which put you purchased. There's different things that determine the price of the protection. For instance, how volatile the market has currently been determines the price, and how long the expiration of the protection is also determines the price. So I didn't want to give examples because it does change, but if you were to work with your financial planner, or if you were to contact me, I could give you up-to-date information, and you could look at the price and you could determine if you felt it was if it was worth it. There's several examples where this, I think it makes sense, and there's several where I think it doesn't. If you were retired, had a significant stock portfolio, and you were attached to the portfolio and you didn't want to sell it, but you were just really concerned that the market was going to go down, a deep out of the money put would probably help you sleep better at night. If you were the executor of a large estate, and let's say that it was complicated and there were a lot of kids involved, and you didn't want to sell the portfolio, maybe some wanted stock, some wanted cash, but what you could do in the meantime before the assets were sold is you could purchase a protective put, enough puts to cover the value of the portfolio from a catastrophic loss. So that would be another case where maybe it would make sense. Cases where it wouldn't make sense, I think if you needed this over a very long period of time, you have to remember that the market typically goes up. So if you own a put, then most likely when it expires, let's say you bought a 1-year protective put, when the put expires, if the market is higher from where you bought it from, it's going to expire worthless. So if the market goes up, say over 70% of the time, according to history, typically when you buy this protection, it's going to expire worthless. So if you were going to do this over a very long period of time, you'd probably end up better off not owning the puts. But if you're older, if you're in retirement, you have a significant portfolio, you want to protect it for a certain period of time, it might not be a bad idea. Another case where it wouldn't make sense, say you were younger and you had a very long investment time span ahead of you. Again, owning this protection, there is a cost to it. So when you're younger, you should be more willing to accept risk and taking the price of the protection and just investing it in the market over a long period of time, you probably come out ahead. But I did want to just point out this is a viable strategy for hedging your portfolio, and I think it is worth considering. If you get updated quotes, if you contacted me, I could tell you exactly what it would cost to do it, and you could determine if it was worth it or not. And again, I think the best way to make sense of this is to kind of compare it to your homeowner's insurance. It's very similar. You'd be protecting against catastrophic loss. If a catastrophic loss didn't occur, then you would lose your premium. And then if you wanted to extend the coverage, you would take out another year of coverage, just like with this. So that's kind of a good way to rationalize it and think of it. So if you have any questions, please reach out. My name is Trevor Johnson from Dreamweaver Financial Planning, and thanks for watching.